Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. IHH Healthcare, one of Asia's largest private healthcare groups, reported stable growth in their latest quarter. The integrated healthcare operator announced a net profit of $732 million, about $221 million for the quarter ended December 31st, showing a modest 1% increase from $728 million in the same period last year. Their earnings per share came in at R0.0831, just slightly up from R0.0826 in Q4 2023. For shareholders, IHH declared a final dividend of R0.055 per share, which will be paid out on April 28th. Despite these relatively stable results, IHH shares declined 2.3% or 0.05 to close at 215 before the announcement. IHH operates premium healthcare facilities across Asia, including Mount Elizabeth and Gleneagles hospitals in Singapore. They've been expanding their footprint in key markets like Malaysia, Singapore, Turkey, and India. The company's steady performance comes amid ongoing recovery in medical tourism and elective procedures following the pandemic years. From a technical perspective, IHH has been trading in a range between $2.10 and $2.25 over the past few months. The recent price drop puts it near the lower end of this range, which might interest value investors looking for entry points in the healthcare sector. Moving to Jardine Cycle Carriage, the diversified conglomerate posted a 4.4% rise in underlying profit, reaching $602 million for the 6 months ended December 31st. Their revenue for this period increased by 9% to $11.6 billion, showing solid top-line growth. However, looking at the full year, Jardine CNC's underlying profit actually decreased by 5% to $1.1 billion. The company attributed this decline to foreign exchange differences, which highlights how currency fluctuations can impact multinational businesses. For those unfamiliar, Jardine CNC is a major player in Southeast Asia with interests spanning automotive distribution, financial services, heavy equipment, mining, construction, and agribusiness. They're perhaps best known for their controlling stake in Indonesia's Astra International. The market seemed to take these mixed results in stride, with Jardine CNC shares ending Thursday slightly up by 0.2% or $0.06 to close at 26.70 tau before the announcement. From a technical standpoint, Jardine CNC has been showing resilience compared to some other conglomerates. The stock has maintained a support level around 26.50, and this slight uptick might signal investor confidence in their diversified business model despite currency headwinds. Olam Group, the global food and agribusiness giant, reported a significant drop in profits for the second half of 2023. Their net profit came in at $38.4 million for the period ended December 31st, which represents a steep 83.4% decline from $230.8 million in the same period the previous year. This translated to earnings per share of just $0.58 for the half-year period, down dramatically from $0.0567 the year before. Despite this profit slump, Olam's revenue actually increased by 24% to $29.2 billion from $23.6 billion, showing that top-line growth doesn't always flow through to the bottom line. The board proposed a final dividend of $0.03 per share, bringing the full-year dividend to $0.06 per share. Investors seemed to react negatively to these results even before they were officially announced, with Olam shares closing 4.6% or 0.05 lower at $1.04 on Thursday. For context, Olam is one of the world's leading food and agribusinesses, supplying food ingredients and raw materials to over 20,000 customers worldwide. They operate across the entire value chain in 60-plus countries, handling everything from farming and processing to distribution. The disconnect between rising revenue and falling profits suggests margin pressure, possibly from higher input costs, supply chain challenges, or competitive pricing environments. The agribusiness sector has been facing headwinds from climate events, geopolitical tensions, and fluctuating commodity prices. From a technical analysis perspective, Olam stock has been in a downtrend for several months, and this latest price drop brings it to new recent lows. The stock is now trading well below both its 50-day and 200-day moving averages, typically a bearish signal. ComfortDelGro, Singapore's largest land transport company, delivered strong results with a 12.9% year-on-year increase in earnings to $115.2 million for the second half of 2023. Their revenue for this period rose by an impressive 16.9% to reach $2.4 billion, up from $2 billion in the same period the previous year. Notably, revenue from ComfortDelGro's public transport business increased by 3.1% during this period. This segment includes their bus and rail operations in Singapore, Australia, and the UK. The company's shares closed up 1.4% or 0.2 at $1.41 on Thursday before these positive results were announced. For those who might not be familiar, ComfortDelGro operates taxi fleets, bus services, rail networks, car rental and leasing, automotive engineering services, inspection and testing services, driving centers, and insurance broking services. They're a household name in Singapore, but also have significant operations in China, the UK, Australia, and Malaysia. The strong performance likely reflects the continued recovery in mobility and public transportation usage as work and leisure activities have normalized post-pandemic. Higher ridership numbers and potentially improved operational efficiencies seem to be driving their growth. From a technical analysis perspective, ComfortDelGro's stock has been forming a base around the 135-140 level over recent months. This latest uptick could potentially signal the start of a new uptrend if supported by continued strong fundamental performance. Sheng Siong, one of Singapore's leading supermarket chains, reported a slight dip in profits despite revenue growth. Their net profit for the second half of 2023 came in at $67.6 million, down 1%, compared to the same period last year. However, revenue increased by 5.5% year-on-year to $714.5 million. The profit decline appears to be due to rising costs as administrative expenses, selling and distribution expenses, and finance expenses all increased at a faster rate than revenue growth. This margin compression is something we're seeing across many retail businesses as they grapple with inflation and higher operating costs. Sheng Siong shares closed Thursday up 1.2% or 0.02 higher at 165 before these financial results were published. The market might have been anticipating stronger results given the price increase. For those who aren't familiar, Sheng Siong operates over 60 supermarkets across Singapore with a focus on heartland locations. They're known for their fresh food offerings and competitive pricing strategy. The company has been gradually expanding its store network, though at a measured pace due to Singapore's space constraints. The retail grocery sector in Singapore remains highly competitive, with players like NTUC FairPrice, Cold Storage, and Giant all vying for market share. Online grocery platforms have also intensified competition, though Sheng Siong has developed its own e-commerce capabilities to adapt. From a technical analysis standpoint, Sheng Siong's stock has been trading in a tight range between yuan 60 and yuan $70 for several months. The stock is considered defensive due to the essential nature of grocery retail, which might explain its relative price stability despite the slight earnings decline. First Resources, a leading palm oil producer, reported impressive growth in their latest results. Their net profit surged by 91.9% to use $141.8 million for the second half ended December 31st, up from $73.9 million in the same period the previous year. Sales increased by 9.4% to $581.5 million from $531.8 million, driven primarily by stronger palm oil prices. The company proposed a final dividend of $0.063 per share, bringing the full-year dividend to $0.098 per share. Despite these strong results, First Resources shares closed 0.7% or 0.01 lower at $1.43 on Thursday before the announcement. First Resources is an integrated palm oil producer with operations primarily in Indonesia. They manage over 200,000 hectares of oil palm plantations and operate processing facilities that produce crude palm oil and palm kernel. The company is vertically integrated, handling everything from plantation management to milling and refining. The substantial profit growth reflects the favorable palm oil pricing environment during the period. Palm oil prices have been volatile but generally strong due to supply constraints and robust demand for vegetable oils globally. As one of the most widely used vegetable oils in food products, cosmetics, and biofuels, palm oil prices can significantly impact producers' profitability. From a technical analysis perspective, First Resources stock has been in a consolidation phase between 140 and 150 for several months. The slight price decline before these strong results were announced might present an opportunity for investors interested in the commodities sector. Looking at the broader Singapore market, we're seeing mixed results across different sectors. Healthcare remains stable but unexciting, with IHH showing minimal growth. Conglomerates like Jardine CNC are demonstrating resilience through their diversified business models, though currency headwinds are creating challenges. The agribusiness sector, represented by Olam, is facing significant profitability pressures despite revenue growth. This disconnect between top-line and bottom-line performance suggests margin compression that could continue if input costs remain elevated. Transportation and mobility, as seen with ComfortDelGro, are showing strong recovery momentum as urban activities normalize. This sector could continue to benefit from increased ridership and potentially higher fares to offset rising operational costs. In retail, Sheng Siong's results highlight the challenges of maintaining profitability in an inflationary environment. While consumers continue to spend on essentials, retailers are finding it harder to pass on all cost increases to price-sensitive shoppers. The commodities sector, represented by First Resources, is demonstrating how price movements in underlying commodities can dramatically impact profitability. Palm oil producers are currently benefiting from favorable pricing, though this sector is known for its cyclicality. Looking ahead, Singapore's market will likely continue to be influenced by several key factors. Global interest rate trends, as major central banks consider easing cycles. China's economic recovery pace, which impacts regional trade, ongoing geopolitical tensions that affect supply chains, and domestic policies aimed at managing inflation while supporting growth. For investors, defensive sectors like healthcare and consumer staples may offer stability in uncertain times, while cyclical sectors like transportation and commodities might provide growth opportunities as economic activity normalizes. The key will be selecting companies with pricing power and operational efficiency to navigate the current high-cost environment. That wraps up today's Singapore Market Digest. I'm Wei from the Investing Iguana, and I'll see you in the next update. Remember, stay curious and keep investing wisely.